Maya was 31, a nurse in Columbus, Ohio, with a modest 401k and a tight monthly budget. One morning she saw a headline: U.S. national debt hits $34 trillion. She texted her brother, "Should I pull my money out of the market?" Her brother didn't know what to tell her. Sound familiar? Today, we're going to answer Maya's question with real data, not fear, not politics, just the facts about what the national debt actually means for everyday Americans like you and her.
Before Maya could decide anything, she needed to understand what the debt actually is. The national debt is the total amount the U.S. federal government has borrowed over time, money it spent beyond what it collected in taxes. Think of it like a credit card balance, but for an entire country. That money funded Social Security, Medicare, military spending, pandemic relief, and more. About 77% is held by the public, regular investors, banks, foreign governments, and the rest is owed between government agencies. It grows whenever Congress spends more than it brings in.
Here's the chart that made Maya's jaw drop. This is the U.S. national debt from 1974 to today. Notice it was relatively flat through the 1970s, under $1 trillion. Then it started climbing in the 1980s with increased defense spending and tax cuts. It accelerated in 2008 after the financial crisis. And then, look at that spike. It nearly doubled during the COVID-19 pandemic. The debt has grown under both Republican and Democratic administrations. This isn't a partisan issue, it's a structural one. And understanding the trajectory is the first step toward knowing what it means for your money.
Here's a number that economists watch more closely than the raw debt total: the debt-to-GDP ratio. Right now, U.S. debt is roughly 122% of our entire annual economic output. That means we owe more than the country produces in a full year. For context, that ratio was around 60% before the 2008 financial crisis. Japan's ratio is over 250%, and they haven't collapsed. But historically, ratios above 90% have been associated with slower economic growth, according to research published in the Journal of Economic Perspectives. This is the number Maya's financial advisor mentioned when she finally called one.
This is where Maya's real question lives. Does the national debt affect my mortgage, my paycheck, my retirement? The answer is potentially yes. When the government borrows heavily, it competes with private borrowers for capital, which can push interest rates higher. Higher rates mean more expensive mortgages, car loans, and credit cards. There's also an inflation risk. If the Federal Reserve ever prints money to cover debt obligations, sometimes called debt monetization, that can erode your purchasing power. And long-term, slower economic growth can translate to stagnant wages and reduced funding for Social Security and Medicare.
Here's the part that keeps budget experts up at night, and it should be on Maya's radar too. This chart shows annual interest payments on the national debt. In 2020, the U.S. paid about $345 billion in interest. By 2024, that number has surged past $870 billion, more than the entire defense budget. Why? Because interest rates rose sharply after 2022. When the Fed raised rates to fight inflation, the cost of servicing that massive debt pile skyrocketed. The Congressional Budget Office projects interest costs could exceed $1.6 trillion annually by 2034. That's money that can't go to schools, infrastructure, or tax cuts.
When Maya dug deeper, she found something reassuring. This is not America's first high-debt rodeo. After World War II, U.S. debt exceeded 100% of GDP. Sound familiar? And yet the 1950s and 60s saw some of the strongest economic growth in American history. The debt ratio fell dramatically, not by paying it all off, but because the economy grew faster than the debt did. There's also a critical factor most people overlook. The U.S. dollar is the world's reserve currency. Global demand for dollars and treasury bonds gives the U.S. borrowing flexibility that other countries simply don't have. That doesn't mean the risk is zero, but history adds important context. Here's a chart that genuinely surprised Maya, and might surprise you too. This shows the S&P 500's performance plotted alongside the rise in national debt over the past 30 years. Notice something striking. As the debt climbed, the stock market, on average, kept going up. That's not to say the debt is good for markets, it's to say that markets respond to corporate earnings, innovation, and economic activity, not just government balance sheets. Investors who panicked and sold every time debt milestones were hit would have missed some of the greatest bull markets in history. The data suggests staying invested has historically been the wiser move.
Here's the number that should genuinely concern long-term planners, and it's the one Maya shared with her coworkers. The Congressional Budget Office projects that if current trends continue, annual interest payments on the national debt could reach $1.6 trillion by 2034. That's more than the U.S. spends on Medicaid today. When a growing share of the budget goes to interest payments, it crowds out everything else: defense, education, infrastructure, and social programs. This doesn't mean catastrophe is imminent, but it does mean this is a problem that compounds, just like debt itself, the longer it goes unaddressed. So what did Maya actually do after all this research? She didn't panic. She didn't pull her money out. Instead, she took 3 practical steps. She made sure her 401k was diversified, not just in U.S. stocks, but including international funds. She added a small allocation to TIPS, which are Treasury inflation-protected securities, bonds that adjust with inflation. And she maximized her Roth IRA contributions, locking in tax-free growth for the future. These aren't exotic moves, they're time-tested strategies that many financial professionals recommend when navigating uncertain macro environments. The goal isn't to predict what politicians will do, it's to build resilience in your own portfolio.
Maya didn't become a debt expert overnight, but she stopped panicking and started planning. She understood that yes, the national debt is a serious long-term challenge, especially the surging interest costs. But she also learned that the U.S. has navigated high debt before, that markets have historically continued to grow, and that the best thing she could do was make her own financial house resilient. Here are the 4 things to remember. High debt is real, but not an immediate collapse trigger. Rising interest payments are the metric to watch. History shows markets survive and recover. And building a diversified, tax-efficient portfolio is your best personal defense. This is educational content only. Please consult a financial advisor for your specific situation. Everything in this video is for educational purposes only and does not constitute financial advice. Please consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results, and all investments